What if I told you that two Americans started with the exact same amount of money, invested on the exact same day, and 30 years later, one ended up significantly richer than the other? One invested in stocks. The other invested in real estate. Today, we're going to find out who won. And the answer might completely change the way you think about building wealth. For decades, investors have debated one question: is real estate the best way to become wealthy? Or is the stock market the smarter path? Both sides have strong arguments. Both sides have created millionaires. But only one can claim the higher long-term return. To make this comparison fair, we're going to use real American examples, historical data, and simple math. No complicated financial jargon. No Wall Street nonsense. Juste fact. Let's begin with stocks. When you buy stocks, you're purchasing tiny ownership pieces of businesses. If those businesses grow, your money grows. It's really that simple. Imagine investing $10,000 into an S&P 500 index fund. The S&P 500 tracks 500 of the largest companies in America. Companies that sell products, provide services, and generate billions of dollars every year. Historically, the S&P 500 has returned roughly 10% annually before inflation. That may not sound impressive, but wait until you see what time does to those returns. After 10 years, your $10,000 could become roughly $26,000. After 20 years, around $67,000. And after 30 years, more than $170,000. Without adding another dollar. Now, imagine investing every single month. Suddenly, compounding starts working like a financial superpower. Money begins creating more money, and then that money creates even more money. This is one reason Warren Buffett became one of the richest investors in history. Not because he made money quickly, but because he allowed compounding to work for decades. Now let's switch over to real estate. Unlike stock, real generate income almost immediately through rent. And that's where things start getting interesting. Imagine buying a rental property in Texas for $200,000. Every month, tenants pay rent. Part of that rent covers the mortgage. Part covers expenses. And what's left becomes income. But that's only the first benefit. Every mortgage payment also increases your ownership in the property. This is called building equity, and your tenants are helping you do it. Then there's appreciation. If property values rise over time, your house becomes worth more money. Now you're benefiting from rent, equity growth, appreciation all at once. This is why so many Americans love real estate. It feels tangible. You can see it. Toucher, improve vite, and collect income from it. But real estate has one advantage that stocks usually don't: leverage. And leverage can dramatically increase returns. Imagine you have $40,000. In the stock market, you generally invest $40,000. But in real estate, that same $40,000 could become a down payment on a $200,000 property. Now, suppose that property rises in value by 10%. The house gains $20,000 in value, yet you only invested $40,000. That's a 50% gain on your original investment. This ability to control large assets with relatively little money is one reason many real estate investors build wealth so quickly. Leverage magnifies gains. Unfortunately, leverage also magnifies losses. And this is where many beginners get into trouble. Imagine that same property drops by 10%. You lose $20,000 in value. Half of your original investment disappears on paper. And that's before repairs, vacancies, maintenance, and unexpected expenses. So far, stocks look simpler. Real estate looks potentially more powerful. But now comes the most important part of our comparison. What do the actual numbers say? Which investment has created more wealth over the last several decades? The answer is coming up next. To find the real winner, we need to look at history. Because opinions don't make people rich. Resultado. Over the last century, the American stock market has produced average annual returns of roughly 10% before inflation. That's one of the highest long-term returns of any mainstream investment. Let's put that into perspective. If someone invested $10,000 in a broad stock market index and left it untouched for decades, history suggests that investment would grow tremendously over time. Not because of luck, not because of perfect timing, but because great businesses continue creating value. Real estate has also created enormous wealth. But residential properties typically appreciate at a slower rate. In many parts of America, home prices have historically increased by roughly 3 to 5% per year over long periods. At first glance, that makes stocks look like the clear winner. 10% growth versus 3 to 5% growth sounds like an easy victory. But that's not the whole story. Remember, real estate investors don't rely solely on appreciation. They also collect rent, and rental income changes everything. Imagine owning a rental property that generates $500 in positive cash flow every month. That's $6,000 per year. Every year, whether property prices rise or not. Now, imagine taking that rental income and using it to buy another property. T'es un notaire. On a noté. This is how many real estate investors slowly build property portfolios worth millions of dollars. Meanwhile, stock investors have their own version of passive income. It's called dividends. Some companies share part of their profits with shareholders through regular cash payments. Many successful investors reinvest those dividends instead of spending them. Those dividends buy more shares. Those shares generate more dividends. And the cycle continues. Whether it's rental income or dividends, the principle is the same. Reinvesting accelerates wealth creation. And the longer the process continues, the more powerful it becomes. Now let's talk about something that rarely gets discussed. Aim. Not investment time. Your personal time. Buying an index fund takes only a few minutes. You can invest from your phone while sitting on your couch. And after that, there's very little work required. Real estate is different. Tenants may move out unexpectedly. A roof may need replacement. A water heater may fail. A plumbing problem might appear at the worst possible moment. Many landlords eventually hire property managers to handle these problems. But property managers charge fees, which reduces profits. This is one reason some investors prefer stocks. They're extremely passive. You don't get calls at midnight because your index fund has a leaking pipe. Now let's discuss taxes. Because taxes can have a huge impact on how much wealth you actually keep. One major reason wealthy Americans love real estate is because of tax advantages. Property owners may be able to use tax deductions, depreciation, and other legal strategies to reduce taxable income. Stocks also receive favorable tax treatment when investments are held long-term. But generally speaking, real estate tends to offer more opportunities for tax planning. So what happens if two investors each start with $50,000 and stay disciplined for 30 years? The stock investor benefits from simplicity, diversification, and strong historical market growth. The real estate is rente à l'income, equity growth, integers. Both can become wealthy. Very wealthy. So, which investment is more profitable in the long run? If we're looking strictly at historical average returns, broadly, diversified stocks have generally delivered higher long-term growth. However, real estate can sometimes outperform when leverage is used wisely. Properties are managed effectively and rental income is reinvested. The truth is that many of America's wealthiest people don't choose one or the other. They use both. Stocks provide simplicity, liquidity, and passive growth. Real estate provides cash flow, leverage, and tax advantages. So, instead of asking whether stocks or real estate is better, perhaps the better question is this: how can you use both to build financial freedom? Because in the end, the goal isn't to win an argument. The goal is to build wealth. If you enjoyed this video, make sure to like, subscribe, and turn on notifications. And let me know in the comments. If you had $50,000 today, would you invest in stocks or real estate? Thanks for watching, and I'll see you in the next video.